Hey everyone, and welcome back to the channel. Today, we're re-tackling a topic that can seem intimidating, but is absolutely crucial for your financial future: investing. You might be thinking, investing, isn't that for Wall Street guys in suits? Absolutely not. Investing is for everyone, and my goal today is to break it down, make it simple, and show you how you can get started, even with just a little bit of money. By the end of this video, you'll have a clear roadmap to start building your wealth. So grab a notebook, and let's dive in. First things first, what even is investing? At its core, investing is simply using your money to buy assets that have the potential to grow in value over time. Instead of your money just sitting in a bank account, slowly losing value to inflation, investing puts your money to work for you. Think of it like planting a tree. You start with a small seed, your initial investment, and with time, water, and sunlight, it grows into a big, strong tree that provides shade and fruit. That's your money growing through the power of compounding. Now, you might be wondering, why should I invest? I have a savings account. Savings are fantastic for short-term goals and emergencies. You absolutely need an emergency fund. But for long-term goals, like retirement, buying a house, or just achieving financial freedom, saving alone usually isn't enough. Why? Inflation. That's the sneaky villain that makes the price of everything go up over time. If your savings are earning 1% interest, but inflation is at 3%, you're actually losing purchasing power every year. Investing is your best weapon against inflation because historically, the stock market has provided returns that are much higher than the rate of inflation. So, how do you actually start? It's not as complicated as it sounds. The first step, before you even think about putting money anywhere, is to define your goals. What are you investing for? Are you saving for a down payment on a house in 5 years? Or are you investing for retirement in 30 years? Your timeline is super important because it determines how much risk you can comfortably take. A longer timeline means you have more time to recover from any market downturns, so you can afford to be a bit more aggressive. A shorter timeline means you probably want to play it safer. Write down your goals. Seriously, it makes a huge difference. Once you have your goals, it's time to figure out your risk tolerance. This is just a fancy way of asking, how do you feel about your investment values going up and down? The market fluctuates, that's a fact. Some people are totally cool with that roller coaster, while others get nervous at the slightest dip. There's no right or wrong answer. It's personal. Be honest with yourself. Understanding your comfort level with risk will help you choose the right investments that won't keep you up at night. Okay, goals are set. Risk tolerance is understood. Now for the fun part. Where do you actually put your money? Let's talk about some of the most common types of investments for beginners. First up, stocks. When you buy a stock, you're buying a tiny piece of ownership in a company like Apple or Amazon. If the company does well, the value of your stock can go up. Stocks have the potential for high growth, but they also come with higher risk. Next, we have bonds. When you buy a bond, you're essentially lending money to a government or a corporation. In return, they promise to pay you back with interest over a set period. Bonds are generally considered safer than stocks, but they also typically offer lower returns. They're great for adding stability to your portfolio. Now, trying to pick individual winning stocks can be really difficult, even for a professional. That's where my favorite options for beginners come in: index funds and ETFs, which stands for exchange-traded funds. Think of these like a basket of investments, An S&P 500 index fund, for example, holds stocks from the 500 largest companies in the U.S. By buying just one share of this fund, you instantly own a tiny piece of all 500 companies. This is instant diversification. It spreads your risk out, so if one company does poorly, it doesn't sink your whole portfolio. ETFs work in a very similar way. They are easy to buy and sell, and they have very low fees, which is a huge plus. For most people starting out, a low-cost index fund or ETF is one of the best and simplest ways to get started in the market. So, how do you buy these things? You need a brokerage account. This is just an account that lets you buy and sell investments. There are tons of great online brokerages out there today, like Fidelity, Vanguard, Charles Schwab, or even apps like Robinhood or M1 Finance. Many of them have no account minimums and offer commission-free trades, so it's never been easier or cheaper to start. Opening an account is usually a quick online process, similar to opening a bank account. One of the most powerful strategies you can use, especially as a beginner, is called dollar cost averaging. This sounds complex, but it's incredibly simple. It just means investing a fixed amount of money on a regular schedule, say $100 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, your same fixed amount buys more shares. Over time, this strategy can lower your average cost per share and takes the emotion and guesswork out of trying to time the market. Trying to buy low and sell high is a game even the pros rarely win. Consistency is your superpower here. Automate your investments if you can, so that money is transferred and invested every month without you even having to think about it. Set it and forget it. A common question I get is, how much money do I need to start? The answer is, not as much as you think. Thanks to something called fractional shares, you can now buy a piece of a stock for as little as $1. You don't need thousands of dollars to buy a full share of an expensive stock like Amazon. You can start with $50, $25, or even just $5 a month. The most important thing is to start. Build the habit. The amount can grow as your income grows. The power of compounding works best with time, so the sooner you start, the more time your money has to grow. Let's talk about a crucial concept, diversification. You've heard the saying, don't put all your eggs in one basket. This is the #1 rule of investing. You don't want to put all your money into a single stock or even a single industry. By spreading your investments across different asset classes like stocks, bonds, and maybe even real estate and across different industries and geographic regions, you reduce your overall risk. If one part of your portfolio is having a bad year, another part might be having a good year, helping to balance things out. This is why index funds and ETFs are so great for beginners. They have diversification built right in. Now, a word of caution. The market will go down. It's not a matter of if, but when. We call these downturns corrections or bear markets. When this happens, it's easy to panic and sell everything. This is usually the worst thing you can do. Selling when the market is down locks in your losses. Remember, you haven't actually lost any money until you sell. Historically, the market has always recovered from every downturn and gone on to reach new highs. The key is to have a long-term perspective. Stay calm, stick to your plan, and maybe even see it as an opportunity to buy more at a discount. Patience is your best friend in investing. So, to recap, Here's your simple plan to start investing. 1. Define your financial goals and your timeline. 2. Understand your personal risk tolerance. 3. Open a brokerage account. 4. Choose your investments. For most beginners, a low-cost, broadly diversified index fund or ETF is a fantastic starting point. 5. Set up automatic, recurring investments to take advantage of dollar-cost averaging. And 6. Be patient and stay the course for the long term. Investing isn't a get-rich-quick scheme. It's a get-rich-slowly but surely plan. It's about building consistent habits and letting the magic of compound growth do the heavy lifting for you over decades. The biggest mistake you can make is not starting because you're afraid or you think it's too complicated. You've got this. Start small, stay consistent, and keep learning. I hope this video has demystified investing for you and given you the confidence to take that first step. Your future self will thank you for it. If you found this helpful, please give this video a thumbs up and subscribe to the channel for more content on personal finance and building wealth. If you have any questions, drop them in the comments below. I'll do my best to answer them. Thanks for watching, and I'll see you in the next one.